This video is created by Jagrat Creation. It is on underwriting of shares and debentures. I wish to solve one sum here before you. Observe the sum on the screen. Saurav Floor Mills Private Limited floated a public issue of 1,50,000 equity shares having a face value of ₹10 each at par. A, B and C has taken underwriting of the issue in equal share with firm underwriting of 25,000, 20,000, 20,000 shares respectively. So A's firm shares 25,000, B's firm shares 20,000, C's firm shares 20,000. Applications were received for 1,46,000 shares, out of which marked application were as under: marked application of A 24,600, that of B 20,000 and that of C 15,000. Credit for unmarked application is to be given to underwriters equally. The agreed underwriting commission was 5%. Total amount payable on application and allotment was ₹5 and balance in calls. Compute the following: liability of each underwriter in shares as well as in amount, commission due to underwriters, and net cash paid and received to the underwriters. Also pass journal entries for above. So I'm going to write down journal entries for all the transactions, including cash transactions. Now see in this sum. Public issue is 1,50,000, applications received 1,46,000. So applications are short by 4,000 shares. So underwriters has to purchase this 4,000 shares of the company so that issue is fully subscribed. Now I want to decide the liability of an underwriter, that who is supposed to purchase this 4,000 shares. Over and above, they are required to go for firm purchases 25,000, 20,000 and 20,000 shares. So total number of shares that underwriters are required to purchase 25 plus 20 plus 20, that is equal to 65, plus 4,000 applications that are so short. So these are the number of shares that the underwriters are required to purchase. How much? 25,000, 20,000, 20,000 plus 4,000. So that will work out to be 69,000. 69,000 shares will be purchased by underwriters, including firm. Now whatever the application received, 1,46,000 includes firm application. That includes firm application. And credit for unmarked application is to be given to underwriters equally. So firm applications are treated as unmarked application. So no straightway credit is given for firm application. They are to be treated as unmarked application. That is an important interpretation that one should hold while reading the sum. Now I want to first of all decide the liability of an underwriter. Let us start with preparation of a table. So applications received were 1,46,000. Issue was 1,50,000. So number of applications short by 4,000. Out of this 1,46,000 application, these are the marked application. So let me first of all find out the unmarked applications which are going to be distributed amongst underwriters equally as I am told in the sum. So first note that I prepare. Total applications 1,46,000. These are the marked applications deducted therefrom. So you will get unmarked applications. These unmarked applications will be distributed equally amongst underwriters. And this unmarked application includes firm applications too. That's an important understanding. Now let me prepare a table for determining the liability. Calculation of liability of each underwriter. That is the first question. There are 3 underwriters, A, B and C. Total issue 1,50,000. A and B has taken underwriting of the issue in equal share. So every underwriter has underwritten 50,000 shares. So 1,50,000 shares underwritten equally. So each underwriter's liability is for 50,000 shares. That's the first important point. From that you are required to deduct the marked applications. Marked applications are the application received by the company because of the efforts of the underwriter, a specific underwriter. 24,600 applications received by the company are such where the stamp of A is found. So it is an application with marking of A. So it is the application received because of the efforts of A. And the direct credit for these marked applications are to be given against the total liability that they have committed. So marked applications are deducted first of all. Straightway credit is given. The remaining balance is this much. Now, from this, you are required to deduct unmarked application in equal proportion. So, unmarked applications, we have already worked out unmarked application 86,400. That is to be distributed equally. So, 86,400 divided by 3. So, 28,800 credit given to A from unmarked application. Remember, this unmarked application the unmarked applications are given in equal proportion. Credit is given in equal proportion, and unmarked application includes the firm application. So this is the liability. Now there is a surplus of 3,400 that will be transferred to B and C in equal proportion. So 1,700 each is the credit of B and C from the surplus of A. So surplus of A allocated to B and C equal proportion. So 1,700 each. So here A becomes nil. Here there is a 500 surplus. That 500 surplus will be transferred to C. So 4,000 shares liability is on the shoulders of underwriter C. So C has to purchase 4,000 shares over and above the firm shares from the company. So this is how the liability is determined. To that you are required to add the firm. So number of shares, A is supposed to purchase 25,000, B is supposed to purchase 20,000, C is supposed to purchase 24,000. So total 69,000 shares are required to be purchased by underwriters. That is made of the firm application plus number of applications found short. That I have already explained to you. The firm applications were 25, 20, 20. So that works out to be 65. 4,000 applications were short. So 65 plus 4, 69,000 is the total liability in shares of this underwriter. Now every share is of rupees 10 each. So multiply this number of shares with 10 rupees. So you will understand the total liability of each underwriter. So multiply with 10, 2,50,000, 2 lakh and 2,40,000. So 6,90,000. This is how the total liability and the individual liability of each underwriter is worked out as per the underwriting agreement. Now I want to calculate the underwriting commission also. And the calculation of net amount to be received from the underwriter or to be paid to underwriter after adjusting the underwriting commission. Now see. Now 2,50,000 is the total liability of A. 2,50,000 towards company under the underwriting agreement. Total liability of B, 2 lakhs. Total liability of C. This is the total liability of underwriters towards the company. Now I want to calculate the underwriting commission, which is to be given at the rate of 5%. It is agreed that underwriting commission was to be paid at the rate of 5%. So 50,000 are the total liability, gross liability. Multiply with the issue price 10 rupees each. So 50,000 into 10 multiplied by 5%. This is the commission to be paid to A. All underwriters' gross liability is same. So commission payable to all underwriters will be same. 25,000, 25,000. This is the commission payable. So this is the total amount to be paid by A. Because he is required to purchase number of shares 25,000. So 2,50,000 is the total capital A is required to pay to company. Against that he can adjust his underwriting commission 25,000. So net amount to be paid by A 2,50,000 minus 25,000. So 2,25,000 is the net amount payable by A. This is the net amount payable by B. 2 lakh on 20,000 shares at the rate of rupees 10 per share. 2 lakhs are required to be paid by B to the company. Against that, B can adjust his underwriting commission 25,000. So net amount he is required to pay 1,75,000. Similarly, number of shares C is required to purchase from the company 24,000. 24,000 into 10, 2,40,000 is the total amount payable. against that he can adjust his underwriting commission 25,000. So net amount payable by C is this much. This is the total amount payable by the underwriters. Now, this is the total amount on shares that they are supposed to purchase. Now, they have already made application for the firm shares. And on firm shares, they have already paid at the rate of ₹5. That is required to be paid with application allotment. So, at the rate of ₹5, on all these shares that they are supposed to purchase, 25,000 are required to be purchased by A, 20,000 required to be purchased by B, 20,000 required to be purchased. Firm applications are already made. So on this firm application 65, they have already paid ₹5 at the time of application allotment, because company has already received this firm application and they are treated as unmarked application, which was distributed equally amongst the underwriters. So at the rate of ₹5, on 25,000 shares at the rate of ₹5, they have already paid 1,25,000 because they have already made firm applications. On 25,000 at the rate of ₹5, they have already paid 1 lakh. C has already paid 25,000 into 5. 1 lakh is already paid at the time of making firm applications to the company. And all those firm application has become the part of unmarked application that I have already explained to you. So this is the amount that has already been paid. Now they are required to pay net amount payable, 2,25,000 minus 1,25,000, 1 lakh. 1,75,000 minus 1,75,000. 2,15,000 minus 1,15,000. This is the net amount to be paid by them. So this is how I have already calculated the cash paid by the underwriter at the time of making firm application to the company. What are the other shares that they are required to purchase? As per underwriting agreement, they were 4,000 shares. And what is the total amount payable thereon? And already amount paid, and the already amount to be paid by, they have already paid 1,25,000, 1 lakh and 1 lakh. This is the total amount that they are required to pay. Here the adjustment for underwriting commission is made and the net liability of each underwriter is worked out. Now on the basis of this calculation, I want to write down the journal entries in the books of company. Please pay attention. Here I am going to write down the journal entries in the books of company. Now, first of all, total 1,46,000 applications are received. Amount received with the application allotment ₹5, and the next amount is to be received 5 at the time of final call. So, total amount payable on application and allotment was ₹5 and balance in call. So, balance amount ₹5 is to be paid with final call. Now, 1,46,000 applications are received. So 1,46,000 into 5 is the amount totally received at the time of application. So bank account debit, 1,46,000 into 5, 7,30,000. Bank account debit to equity share, application and allotment account credit, 7,30,000. So 1,46,000 total number of applications are received. At the rate of ₹5 per share is to be received. So 1,46,000 into 5, 7,30,000 is the amount to be received. So bank account debit to equity share application and allotment account credit, being share application money received. I just write narration in a very brief form because I want to accommodate all the journal entries on a small screen. So you can write narration in a detailed way in your own language, but tolerate the small narration that I present before you. Now, bank account debit to equity share application and allotment account. Now all the shares are allotted. So 1,46,000 equity share application and allotment account debit, 7,30,000. Now C is required to purchase 4,000 shares because we have already worked out the liability. So C's account is to be debited 4,000 into 5, 20,000 to equity share capital account credit, 7,50,000. Now 1,50,000 shares, each of ₹10 each. So total share capital 15 lakhs. How the amount is received with application and allotment. So 7,50,000 will be transferred to equity share capital account at the time of allotment of the share. So equity share capital account is credited with 7,50,000. being as per the resolution of Board of Directors, shares are allotted. So remember once again, number of shares issued are 1,50,000. Issue price, face value of the share is 10 rupees. Total amount of share capital to be collected 1,50,000 into 10, 15 lakhs. Half the amount is received with application and allotment. So equity share capital account is credited with 7,50,000. So this is how first two entries are recorded. Now I wish to write down the entries for final call. The final call is to be recovered at the rate of rupees 5 per share. On how many shares? On 1,50,000 shares. So amount to be recovered on final call will be 7,50,000. Now, out of this total allotment of 1,50,000 shares, 69,000 shares are allotted to the underwriters and the remaining shares are allotted to the other allottees. Let me work out the number. So total issue 1,50,000 shares. Number of shares allotted to underwriters 69,000. So allotted to others 81,000. Now 81,000 into 5. That is the amount of final call to be demanded from the others. And on 59,000 shares, the final call demand is to be made from underwriters. Let me make a journal entry for demanding the final call. So equity share final call account debit 81,000 into 5, 4,05,000. Amount due from A 25,000 into 5, 1,25,000 is account debit. B's account debit 20,000 into 5, 1 lakh. C's account debit 24,000 into 5, 1,20,000. 2. Equity share capital account credit 7,50,000. So equity share capital account is credited with 7,50,000 and 7,50,000. So total equity share capital account is credited with 15 lakhs. This is the amount credited at the time of final call. This is the amount credited at the time of allotment of the shares. This is how the demand is made for final call. Now we are going to receive the final call subject to the adjustment of underwriting commission. So before we receive the final call, let me write down the entry for underwriting commission. Being the call amount due on shares, that is the narration, small brief narration that I have recorded. Now let me write down the entry for underwriting commission. So the underwriting commission at the rate of 5%, this is a 75,000 is the total underwriting commission is to be paid to A, B and C. Each is entitled to a commission of 25,000. So underwriting commission account debit, to A account credit, to B account credit, to C account credit. So this is how, being the underwriting commission payable to A, B, C, this is the entry for underwriting commission is recorded. Now final call dues from A, 1,25,000. Adjustment of underwriting commission 25,000. So net amount that I am going to receive from A, 1 lakh, that is already mentioned here. Now B, final call dues from B, 1 lakh. Underwriting commission that gets adjusted against 1 lakh, 25,000. 75,000 is the amount that I am going to receive from B. So now let me write down the entry for the amount received at the instance of final call. So bank account debit. How much? 6,95,000. How much? 2,90,000 is this amount and 4,05,000. So 6,95,000 is the total amount received at the instance of final call. Bank account debit 6,95,000. 2. A's account credit 125 minus 25. A's account will be credited with 1 lakh. That is already recorded here. B's account will be credited with 1 lakh minus 75,000. 1 lakh minus 25,000, 75,000. This 75,000 is already calculated and mentioned here. And amount to be recovered from D, from C. How much? 1,20,000 plus 20,000, 1,40,000. 1,40,000 minus 25,000. So 1,05,000. And remaining amount will be credited to equity share final call account, that is 4,05,000. So 20 plus 120, 140 minus 25, 1,05,000, 1,15,000. That are already calculated 1,15,000. And the share final call 4,05,000 is already received. This is how the amount received on final call, being the net amount received at the instance of shares final call. This is how the journal entries are recorded in the books of company, wherein at the time of final call demand, the adjustment for underwriting commission is made and the net amount is recovered from the underwriters. This is how the whole sum is solved here before you. I have recorded journal entry. I have recorded journal entry wherein I have recorded the entry for cash transactions also. Now in examination, student can tactfully avoid the cash, bank debit and bank credit and can write the entry for the net amount. That is also possible. But for the better explanation of the journal entries, I have recorded all the journal entries for understanding for the student. I have tried to explain you this, sir. I feel that you follow all these things. Thanks to you.